The other question is whether sellers are satisfied by the transaction. Because in professional services, whether it's law or accounting, or in this case, financial advice, the ultimate duty is to the consumer, to the client, to the investor. And you always have to ask yourself the question, is the client better off post-transaction than they were pre-transaction? Because ultimately, that is a legacy that you're going to leave behind.
Welcome to the Fueling Deals Podcast, the podcast that teaches how to accelerate your business growth through all types of deals. It's time to fuel up, so buckle in with your host, Corey Kupfer.
There are only two ways to grow your business: organically through sales and marketing and providing great products and services, and inorganically through deals. Too many companies focus only on the first way, organic growth. Welcome to the podcast, which will help accelerate your business growth inorganically. My guests are a huge variety of deal makers and experts on all types of deals who have personal experience that can help you grow, get clear, learn best practices, and avoid mistakes. We discuss everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My guest today is Mark Tibergien. Mark joined BNY Mellon Pershing as head of its RIA and Family Office custody unit in 2007 and is the chief executive officer of Advisor Solutions and a member of Pershing's executive committee. Prior to joining Pershing, he was a principal at Moss Adams LLP, where he was partner in charge of the business consulting group and chairman of the financial services industry group. Since 1973, he has worked on strategy, management, development, and transition planning with hundreds of independent RIA firms, broker-dealers, investment managers, insurance companies, and other financial service organizations worldwide. Listen, so I'm not going to read his whole bio. Check it out. He's written 4 books. He has all kinds of awards. All of that will be in the show notes. I've known Mark for a number of over a decade, in this in the RIA industry. But Mark also has a background in other industries and is really just a leading voice and thought leader as to not only the financial services industry, but growth of firms in general. And it's a real honor and privilege to have you on the show, Mark.
Thank you, Corey. Good to be here.
Well, so I want to start out before we get into all your wisdom and hearing a little bit more about BNY Pershing and what you do. I want to take you back to when you were a little kid growing up. What did you want to be? Because my guess is running a custody, firm in the RA space was probably not it when you were 8 or 10 years old. But you tell me.
Well, that's a fair guess. My only knowledge of a custodian when I was 8 or 10 years old was who had the most keys. So much has changed. Actually, I don't know at what point I had this epiphany, but I was quite sure I wanted to be Walter Cronkite. I was drawn to journalism, and in fact, the first couple of jobs I had were as a newspaper and radio reporter. So I did have an experience there that was profound. In fact, my very first job was reading and writing obituaries for the radio.
Wow. Okay, that's interesting. How did that one come about?
Well, I think I've come full circle.
So did you have, before you actually sort of anticipated my second question, which is really sort of, what was your first either business or job? But when you were a little kid, did you have, did you want to be, it was a news reporter? That was it at that time? It was Walter Cronkite?
Yeah, it truly was. I grew up in the Upper Peninsula of Michigan, which, for those who don't know the state, it's not even on the hand, it's above the hand. It's well north of Toronto. So many people leave it off the maps. And up there, you hunt, fish, or drink. And it used to be a big timber and mining part of the country. My dad was a building supply salesperson. My stepmother worked for an office manager within an oil distribution company. So the real models for the things I wanted to do were either working at the paper mill or some other industrial role, or in some liberal arts role like a journalist. And I figured that journalism was the key for getting me out of town. And so that's why I chose that route.
Got it. So let's sort of jump ahead here, and then we can sort of go back to some of your experience in between then and now. But as I said, we have a lot of people in the industry who know you and know BNY Mellon Pershing and what a custodian does. But we also have a bunch of listeners outside of the RIA industry who may be a lot less familiar. I mean, I know I'm sure they've heard of BNY Pershing, but they may not even understand exactly what a custodian does. So can you give us that basic information so the audience has a context?
Sure, happy to do it. So, as a part of BNY Mellon, which is formerly known as Bank of New York and Mellon Investments, so it's a merger of two companies. So, Bank of New York was founded by Alexander Hamilton. It's the oldest financial institution in the country. At one time, it was a retail bank, but eventually decided to focus primarily on being an institutional bank. And the substance of that is, as a custodian, which is our primary business, our job is to hold the financial assets of clients safe. And so in many cases, that's opaque to investors because they might be working with a broker-dealer who provides all those services as part of a captive experience. But those who outsource custody to an independent firm will recognize that a company like BNY Mellon Pershing has a primary role of ensuring that the assets are kept safe and that the advisors who are managing the money using our platform are doing things in a copacetic way, ensuring that there is no money laundering, no mismanagement of the assets, and all those other elements.
Great. And so in addition to that, with like the independent RIA firms on your platform, et cetera, you also help them grow in certain ways, including through deals. So you want to talk a little bit about how a firm like Mellon Pershing supports advisors in their growth?
Sure. What's interesting about the custody business in financial services is that custody itself is probably among the most commoditized elements of the business. And so in order to deliver a richer experience to both the advisors who recommend their clients to us as their custodian or to the clients themselves, we have to think about the ways in which we enrich the value. It's a common problem in any business that is trying to say, how do we distinguish or be different in the market? So from our standpoint, what's key is that we think about the business of financial advice as our core proposition. And we're looking at things like strategy and structure, people and process, managing to profitability. In that context, we often think about, should firms merge or acquire? And if so, what are the integration challenges that come with it? And is there special insight that we can provide on market trends or market issues or financial dynamics within the business that will help both buyers and sellers make informed decisions about the transaction? We obviously don't act as an investment banker, nor do we act as counsel in those cases, but we do act as a resource to deliver higher value to clients who recognize us as a trusted partner.
So you said something interesting there, which applies in this industry, but really applies to any type of business. And I know you have a background, outside of financial services as well. You said sort of helping them decide, a consult on whether they should or should not, right, do deals. And
yes, right.
And I'll assume an answer that the truth is some of them should and some of them should not. And so what I'd love to hear is what your view on what some of the factors are on who should grow or should not grow, and who's successful at it, and is it, and it sort of plays into this thing that I'm always fascinated by, which is sort of the who becomes deal makers and what that means versus the people who are just don't have that ability.
Yeah, it's a great combination of questions. Something I wrestle with quite a bit, because when I look at any business, whether it's financial services or some other type of business, the question is whether the merger or acquisition fits into the strategic goals of the business. I think today in financial services, we're seeing a lot of sellers who are seeking liquidity and are not seeking a strategic partner, but merely are seeking money because they haven't planned for their own continuity or cash out internally. I think for many of the buyers, it's more opportunistic shopping, where there are sellers who are available, and there are probably 40 to 50 prospective buyers who are making offers. So it's much like an auction. And so the terms tend to favor the seller in most cases, but they're making these acquisitions with the hope of getting to scale. The challenge that many of these firms have that are on the acquiring side is they don't really have a strategic blueprint for what they're creating besides getting bigger. That if you're sitting in Oshkosh, Wisconsin, does it truly make sense to acquire a firm in Orlando, Florida, or Omaha, Nebraska? And so you have to begin asking yourself the question is, what's the commonality? What's the element that ties you together? And can you, in fact, get scale when you're so disparate in your geographic markets? The same may be true in terms of your customer base, that taking an advisory firm again, if you're dealing with high net worth clients, does it necessarily make sense that you'd buy a firm that specializes in retirement plans, or that is a digital platform, or that is some other organization, perhaps in insurance? And it may make sense, but the question is, will you knit these together in a way that delivers a coherent strategy? So one thing that I think is true is that the volume of activity, the volume of mergers and acquisitions in financial services is at a record level. The concern that I have now is whether the buyers will begin to digest what's happening, and they will begin to integrate, truly create synergies and build a brand, and whether the employees that came over with those transactions will stay or choose to go to another firm. The other question is whether sellers are satisfied by the transaction, because in professional services, whether it's law or accounting, or in this case, financial advice, the ultimate duty is to the consumer, to the client, to the investor. And you always have to ask yourself the question, is the client better off post-transaction than they were pre-transaction? Because ultimately, that is a legacy that you're going to leave behind.
Yeah, I love everything you said, and it raises, there's a lot in that we could unpack, probably for much longer than we have for this entire podcast, just in this piece. But, a few things that I want to sort of point out and then see if you have anything you want to say on them is, the first question, I did a 10-tip video series, if anybody wants to look at it, it's on my website, but on why, on 10 steps for RIA firms who want to do deals, whether it's M&A, tuck-in or onboarding deals. And the first video is about why. It really goes to what you talked about. I mean, you need to have a why and a coherent, that goes to a coherent strategy on why you're doing it, and just growth for growth's sake is not it. And then you raised a whole conversation about integration, which there's so many parts to, right? From cultural to technical to, client service and investment, platforms and approach. And then you didn't specifically talk about, but you sort of alluded, in terms of the number of buyers versus sellers and the incentives to growth, always raises the concern for me about what I always call deal discipline. And I've seen it in so many industries where money starts to come into the industry, and they mature, and it's a positive economy and things are going well, and then deal discipline is lost, and then we get a downturn, and then there's always a shakeout. So I know I sort of summarized a lot there, but any thoughts on any of those particular areas?
Yeah, several things. One, I love the idea of beginning with why. It's always a good question for anything you're doing. Sometimes it's just an emotional decision, so you don't look for the reason why. But if you're a rational business person, you always have to ask that question: is what problem am I solving, or what opportunity am I gaining? And if it's merely size, that is rarely a good argument for committing the resources, the time, and the energy into an acquisition. Size by itself rarely accomplishes much. And in fact, you and I both have been around mergers and acquisitions in all industries long enough to know that many of the industries that have consolidated in the past have really failed. Whether you look at funeral homes or medical practices or waste management, might be the only one where there is real success in consolidation. And there are so many moving parts that get into it, but you have to say, why would you do this besides the pure economics? The other element to that is this whole notion of what do you accomplish once you go through the process, and how will people feel? Will the clients be served better as a result of getting to scale or adding new dimensions to your business that make a difference? And I think those are big questions that always occur. So, Yeah, I think that there are deals that are not well contemplated and not well executed. And the test for me is what does the business look like 3 years after a transaction occurs? And unfortunately, you can't anticipate that, but you can try to manage to it. And if people who are part of the combined organization feel that it's an additive culture, not just a culture fit, but an additive culture, and they feel that the business has enriched its brand and has enriched its offering, and it has become a more compelling place for both clients and employees to do business, then you've accomplished exactly what you want to accomplish. Ultimately, the measure is in financial terms, but I think that we recognize that this is a momentum business. People make decisions for emotional reasons, and some level of emotional fulfillment has to come from that as well.
And what do you think the impact has been? I mean, obviously, we've seen such a significant change in this industry over the last 5, 7 years, even in terms of private equity. Money coming in. We've had a couple of firms go public, I've seen this in other industries as well. It's pretty typical. Part of a cycle of a maturing industry, right? Where, capital starts to come into the industry and there's consolidation, but what have you seen as the impact of that, and how do you, good and bad in the RIA space?
I think it is both good and bad. The beauty of private equity or any capital coming into this market is that it's validating the independent advisory model. This is an industry that fundamentally is made up of small businesses. Most of them are not at scale. And so having professional investors come in and say, we want to put money behind these models in order to create more substantial businesses, I think is a great testimony to the elegance of the fiduciary advisory model. I think the downside is that for many, it's just a transaction. Advisory firms tend to be very profitable. They tend to grow at a good pace. Their ability to generate revenue just by accumulating assets is significant, and it's not a balance sheet heavy business, and so capital from that standpoint isn't required. It's more of a P&L business. And I think that it becomes very appealing for professional investors that they can buy low and sell high. And obviously, that doesn't create this enduring model that one would hope to create. So I think that when buyers are seeking private equity, it's important that they pick partners that have the same vision as to what they're trying to create, and perhaps even reconcile that it's a temporary relationship, not a permanent one. Equity tends to be permanent. That by definition is what it is, but the relationship doesn't have to be. The question is, how will you ultimately change that dynamic? The other question is whether, if capital is required, if firms shouldn't be looking for a less expensive source like debt. Is there another way in which to approach this, or even their own paper? Is there a way in which to think about mergers rather than acquisitions? But generally speaking, I find that the inclusion of capital from private investors in the business has been a good thing, because it has forced firms to think more about managing professionally and creating a discipline around financial management that makes a difference. But I don't know that we have seen the side effects yet of passive shareholders, and whether or not they can help firms that combine to create an enduring culture.
Yeah, and so let's take that a step further. So we, obviously we don't know when, but I think pretty much everybody agrees that we run in cycles, and it's at some point, whether it's 6 months or 2 years or 6 years or who knows, we're going to have an economic downturn. And of course, in this industry, it's it's sort of a double whammy, right? So the firms that are looking to grow rapidly, and the money coming in, and there may be fewer, or by the way, more opportunities. Sometimes, like, there's huge opportunities in the down market, but also in addition to the general economic background, if asset values go down in terms of assets under management, that affects revenues of firms that get mostly paid on a percentage of AUM. So, what do you, whenever that comes, in light of the evolution and maturing of the industry and the money that's coming into the industry and the consolidation, that kind of stuff, what do you think are the impacts of the next downturn?
Well, I think that the professional investors get a preferred return in most cases.
Yep.
But even if they don't, I think the notion of taking a longer view is critical. Normally, whenever we see any market cycle, it doesn't last for decades. It doesn't last even for multiple years. It might be maybe 2 years that you might see the stress that occurs on a business. I mean, we could see something worse. Anything's possible. 2008 was a real shocker. There are a lot of banks that disappeared as a result of it. I think, though, the question is if you really fundamentally believe in this business model, in that it has value beyond the management of assets, but it is impacting the lives of people who really relish professional advice, then as a concept, it creates opportunity. So in a down market, to your point, I think probably it creates more rational pricing in the market than what we see today. As I mentioned earlier, it's very much a seller's market, and price and terms tend to inure to the benefit of the sellers in this case. So there probably are some buyers that are hoping for a little interruption in this momentum so that prices come to the realm of reason. Right now, sellers have a perception of value and greatness that is out of proportion to reality. So anytime you can shock them back into what should be more normal economics is probably a good thing.
Yeah. So let's talk a little bit about what we're seeing in terms of the changes in deal terms because of that. Because I've definitely seen an evolution, not only in terms of valuation, but even in terms of deal structuring, more money up front and that kind of stuff. So, what are you seeing in terms of deal structure and term evolution in this day and age in the space?
Well, I think you hit it. Obviously, there's more down. The multiples are higher in some cases, or actually the dollar amount is higher. I don't know necessarily the multiples are higher. And the terms tend to be shorter for the benefit of the seller. And there probably is less dependency on performance of the business post-transaction. So I think when you have an auction market like we do today, that's causing people to sweeten the deal in different ways. The part of this, though, that concerns me is there are a number of firms that are being acquired that have old demographics. Their principals are old. Their clients tend to be as old or older. Many of them are entering into deaccumulation phase. The firms have not demonstrated any momentum around new growth. And so, I've always learned that value is a function of the future. And what concerns me about some of the deal structures is that they're not recognizing the future in terms of the pricing and terms, but they're basing it on historical performance. And so this is where reconciliation ultimately has to come into play. But I would imagine that many buyers are saying, as long as we have the core asset, as long as we have the bulk of the clients, as long as we have a brand in a market, we can transform this into a great asset going forward. And that's a relatively safe bet, as long as the people who are there continue to feel valued in the process. And so that may become the big challenge for a lot of firms going forward, is how do you not only keep the people that have built the firm to this point, but how do you attract new talent into the marketplace and into the business to drive it forward?
And obviously, you and I have had these discussions in the past, and we've been at conferences where this has come up. And obviously, that's a big challenge in the industry, is that next gen challenge and the lack of development, of recruiting and development of junior talent. So I think that point about being able to do that is crucial, right?
It's an area that I'm spending considerable time on. I chair the Workforce Development Committee for the CFP Board Center for Financial Planning, and we have a couple of missions. One is, how do we attract more people to the business? And second, how do we increase the diversity of the advisor population? So we have 40,000 fewer financial professionals today than we did in 2008. Yet the number of wealthy people that have come into the market, or the amount of liquid assets that have come into the market continues to grow. So the beauty is we have this oversupply of clients and an undersupply of people to provide advice. But the age demographics are disturbing, with the average age in the high 50s. And the other diversity elements that are of concern are there are only 23% women who are advisors and only 8% people of color. Yet we see the changing dynamics. We know that in most families, women are making the economic decisions. We know that in roughly 20 or 25 years, we'll be a majority-minority country. We know that if we look at the economic power of Black Americans, it's bigger than the economy of Russia. If we look at the economic power of Hispanic Americans, it's bigger than the economy of Russia. If we look at the economic power of Asian Americans, it's bigger than the economy of Russia. So if you're smart about it, you would become the employer of choice as a way to grow this business, because we want to have people in our business that reflect the faces of our community, but we also want to be compelling to people who are growing wealth on their own that are not seeking professional advice.
So, yeah, I love that, because it totally aligns with not only my values, but my view, which I agree with, in the industry. And even if, you don't have a commitment to diversity for other reasons, it's just smart business. I mean, demographics, are what they are. So I'm curious as to what. So on a deals podcast, right? I don't only deal with mergers and acquisitions. I look at doing deals with your internal people, creating partnership tracks, right, and having them be able to buy in on equity or things like that are deals as well. And then obviously that makes the possibility of an internal succession deal even more possible. But practically, as we've alluded to, a lot of firms, the majority of firms, I don't think are doing a good job of that. What do you think it is that's preventing, are we talking about lack of knowledge? Is it talking about ego, inability to give up control, poor training? What's involved in the fact that this industry has not done a great job? I mean, I can sort of think of the clients that I've worked with where we've helped create an opportunity for the second generation, partnership track, tied that into the succession of the seniors. And when you do that right, it could be phenomenal. It's just such a minority of firms that have successfully done that.
Well, there's a certain irony in all of this. It's like having an obese doctor. You kind of wonder if they're practicing what they preach. And I think in financial services, we see the same thing, where they're counseling people on decisions related to both money and emotion. And I think what we find in this business is that it is comprised primarily of small, closely held businesses. These are individuals who were pioneers. They created a practice of some size, but generally they are small. They don't have a depth of talent around them, particularly of management. Oftentimes they don't believe that the person that's worked with them for 20 years has matured beyond their teenage years, or that they haven't developed the skills. And so there's this level of underestimation that occurs. They often say that they can't afford to buy my practice, which befuddles me, because if the cash flow supports the purchase price, then there's always a way of structuring a deal to make that happen. But I think that fundamentally what happens is people are confusing succession planning and sale planning. That succession planning is really about transitioning in an orderly way your clients and then ultimately the management of your business. And if you do that right, that enriches or enhances the value and allows for the orderly transition of the business. Generally speaking, you probably want to have 3 candidates for succession for every one owner. So the question is whether or not you're building a business that leads you in that direction. I think that what is happening in a lot of cases is firms don't want to put in the effort or don't know how to put in the effort to create this business to last. And as a result, they seek liquidity instead of investing in an enduring business. And so this becomes a real challenge in the business today, when people build something and then they sell it, and there isn't this whole notion of how we continue it. And I think that if people began to recognize that succession is a growth strategy, not an exit strategy, then that will become important. Another element that I think comes into play here is that and you know this just in the course of your transactions, is whenever you give up control, particularly ownership of the business, but any degree of control, it is the single most emotional thing that that business owners have to deal with. It's somewhere between giving their daughter's hand away in marriage and giving her up for adoption. And I think that this becomes a challenge for many business owners, is to reconcile their own insecurities or their own sense of control with the liberation that comes from empowering others to be responsible for what the business does.
I love that. I love that. Let me just take it in a different direction for a moment. So you have, like I said, a background in other industries, and I'm going to ask you to give the listeners just a little bit of more insight into that. And my question after you do that is going to be, what have you seen across industries? Either that, things you've seen in other industries that you maybe now are informing what you do in the financial services space, or just things generally that relate to deals that are universal, across industries that are important for people to understand.
Sure, great question. So this is my seventh career. As you mentioned in the preamble, I never envisioned working for a bank, let alone working in the custodial division of a bank. It's not even something that was on my career path or something I would contemplate. So I did evolve through journalism into being part of an investment research and management firm. Then I joined a consulting firm that also did training for closely held businesses around the globe on how to manage from a financial standpoint. And we also did training for bankers on how to lend to closely held businesses, which we did around the globe. And that, perhaps more than anything, was transformative in terms of how I think about business. Because frankly, as a liberal arts journalist major, thinking about finance and money was so far removed from my frame of reference that I was actually afraid of it until I wasn't. And that was because of good training that allowed me to get there. So at that stage in my life, I would say that the commonality that I see crosses all businesses is to understand what the financial statements are telling you. It's not a score. It's like an EKG. It's giving you a pattern that you have to understand. So when you look at the income statement, you're trying to understand things like pricing and productivity and product mix and service mix. You're trying to understand cost control and whether or not you're managing to the gross margin. And so all of these dynamics really inform certain decisions as to, are you driving the business in the right direction? Is it a volume problem or is it a management problem that is core to that? The second thing that it's helped me to understand is that every business should have a balance sheet, even when you're in a service business. The balance sheet gives you great insight because not only does it tell you what you own, but it tells you how you're funding it. And so the conversation that we had about private equity really would be instructive for many advisory firm owners to say, if I'm capitalizing this business, do I have the right mix between short and long-term debt and equity? And how am I building equity? Is it through retained earnings or through some outside source? This becomes critical. The third is related to cash flow. If your outflow exceeds your inflow, then your upkeep will be your downfall, fundamental to closely held business management. And when we think in those terms, we create a different outcome. So I would say that has applied to companies, whether they're in manufacturing or distribution or retail or service. Those are core lessons that we can use as a framework. The second lesson probably happened when I was running a valuation business. And this is really core to thinking about what are you trying to accomplish, is that, as I mentioned before, value is a function of the future. But when we look deeper, what we find is that value is defined by cash flow, risk or perceived uncertainty, and growth. And so when you're building a business, you have to be striving for a reasonable level of cash flow that's growing and that is not subject to extraordinary risk. And when you do that, you create a higher value. I think the third thing probably came after I merged our consulting firm into Moss Adams in the mid-90s. Moss Adams was a growing firm by itself. It was a consolidator in the accounting business. It's now one of the larger accounting firms in the country, certainly dominant on the West Coast. And what was core to their business is their belief in adding value, having not a cultural fit, but a cultural add in how they approach the business. And the CEO of that business, a guy by the name of Bob Bunting, was really an incredible leader and instructor on how to think about what sort of organization you're building. And he conceived of this acronym that I still use in my life today that defines the cultural values you want. The acronym is PILLAR, PILLAR, which stands for passion, integrity, lifetime learning, lead by example, accountability, and respect. Those principles I apply in my own management, and it's something that I look to when helping other businesses to make decisions on how they do things. So those are some examples.
That's all great stuff, and it's interesting. I mean, going back to I love that last point, by the way. That the PILLAR acronym is phenomenal. But going back to the first point, it's interesting to me. As a lawyer, I remember when I started my own firm in '92. I was actually one of the few lawyers who actually did well on the math section on the LSATs. Like most of my law firms hated math. They couldn't, like, financial statements were foreign to them. And it's funny. So I don't know why. I guess maybe, I was entrepreneurial since I was a kid. So as I was looking at that. So, I remember when I had no clients, I was running P&Ls and balance sheets and cash flow statements every month, with nothing on them, which is funny. But actually, my experience is having clients, across industries, with a concentration in the RIA space. But I mean, you name it. I find I find in general, it's an area that people can definitely improve in. And I think in the service, I think. It's true across the board, but in manufacturing and retail, I think they're almost forced to be more focused on, cost of goods sold and various metrics because they have products. But and not that they all do a great job, but I feel like in the service industry, especially when people are, in those industries where they're selling their time, quote unquote, it tends to be particularly bad at it generally, and I'm wondering if that's your experience, and I know for advisors that Pershing Advisor Solutions has some practice management assistance and strategic consulting help them do that. But what is your sense of overall where people are at around that?
I think that's a fair assessment, and that really is a value that we try to deliver. Is we're all about the business of financial advice, so we do business consulting rather than drive-by practice consulting. We're really interested in things like strategy and structure and people and process and profits. These are things that we live and breathe and try to benchmark and inform the market around. I would say there's a certain irony that people can't translate the personal financial issues and the business financial issues. There are differences in terminology and different ways of looking at it, but these are principles that are really fundamental to how you want to run the business. As an example, I often hear advisory firms talk about EBOC, earnings before owner's compensation. And I'm thinking, well, that's really kind of an interesting concept, but I don't know that it's really helpful from a management standpoint, because I want to know all costs to the business. And if I'm an owner, I want to know what's my reward for labor and what's my reward for ownership. So if I were contemplating an acquisition or a sale, what I would want to do is to determine what fair compensation is to the principal who's going to be working in that business after the deal. And I know of no owners who sell their businesses who say, and now I'm going to work for free. And it's not just the purchase price. There's still some role that they're going to perform. So that's a good example of saying when you construct a proper financial statement, you account for all costs, including your costs for labor in the business. And anything above that in the form of profit is your reward for risk or ownership. And that helps you to manage to a different outcome when you do that.
I love it. It's interesting, Mark. I have that conversation very often with the breakaway teams, when we're first helping teams leave warehouses, banks, trust companies, and set up on their own, because they often are trying to figure out how to divide equity, and how to pay themselves. And, the one of the fundamental things I start them out with is saying, hey, in your current situation, employed at Merrill Lynch or Morgan Stanley, UBS, whoever it is, right? You're an employee, and although you have a book of business of clients that are loyal to you, that you're able to fortunately move, they're clients of the firm. You don't really own anything. The biggest difference, or at least the initial difference, when you're going independent, is that you have two hats. You have your advisor, producer, hat, and then you have your own hat. And you need to distinguish between the two of those. And, that brings in a lot of stuff that we won't have time to go into all kinds of detail on. But, it brings up conversations of, no, you shouldn't necessarily divide your equity by default by relative production. There's other value people bring. I happen to lean towards saying, hey, on the advisor side, if you can have a program on how, your advisors get paid, you should probably just slot into that with your advisor producer hat on, but then obviously you have the separate bucket, where you get paid as an owner. So I love that you made that distinction. It's a conversation that comes up for me with every breakaway team.
Yeah, well, that's a great example of how people tend to get confused by their role, because when they were at a wirehouse, they were a salesperson. By any other name, they were a salesperson. Their whole job was to generate production. But one of the compelling elements for becoming a fiduciary advisor is because they see themselves as an advisor. And what they maybe eventually come to recognize is that only 5 to 10% of the revenue comes from new sales or new growth or new clients. The rest is coming from servicing and retaining existing relationships. And so that naturally suggests that the reward structure has to reflect more the business model that they've created. They can argue all day long that they are fee-based or fee-only, but if their internal compensation is still based on production, then they're really not living that truth. They're basically saying everything is based on the revenue we generate rather than the service we deliver. So it doesn't mean they should make less. It doesn't mean that they shouldn't pay bonuses, but it does mean that creating a compensation model that's in harmony with the culture that they're trying to create is important. And this also means that unless they create some discipline around compensation that is more business-like, it will be very difficult for them to recruit and retain the right talent. It will be very difficult for them to create operating leverage and to develop career paths for people, because the expectation is that the only people you bring in are other producers, when in reality, there are things that producers are doing that they should be delegating to other people. So I think that's a really healthy discussion to have about the transformation of this business, and ultimately how those that used to be employee salespeople within a captive organization are now business owners that have to create alignment with their financial structure and their compensation structure to create this enduring business.
That's great, Mark. Listen, I feel like we could talk forever, but we're coming to the end of our time on this podcast, and maybe we'll have you back on at some point, because there's 100 different topics I know you and I could provide value for. But I think for this one, I'm going to have a last question for you. But before we go there, I just wanted to give you an opportunity. If people want to find out more about BNY Mellon Pershing, or you, or reach out, what's the best way for them to? Where should they go?
Easiest thing is to go to Pershing.com. That's our website. Look for the Advisor Solutions link, or I can be LinkedIn at Mark Tibergien, Tibergien. Would love to communicate with anybody who's interested in this business or how we might work together.
That's great. And folks, Mark is really, I said it up front, but he's really one of the real thought leaders in this industry. Not only does he run, one of the top custodians, in the space, but, the content he puts out, I've seen him speak at a number of conferences, and, he always really has very insightful thoughts into all aspects in the RIA space, and and growth, and has a phenomenal background. So definitely check him out and check out Pershing. So Mark, my final question for you is one that I close every podcast with, and Authenticity is one of my highest values. For me, that is not a conversation of some sort of external morals or ethics, although those are important, but they're different. But it's more sort of alignment within a truth and living a life and making business decisions from a place, because it sort of goes back to that why question we talked about earlier in deals. I think everything should come down to the why. Why are you going independent to start your own firm, right? Why do you want to grow? Why do you, to have, for me, it's really about why become an entrepreneur? Well, we want to create a business that, that serves us and aligns with our values. So I'd love to hear your thoughts on authenticity, how it impacts, you and your business, and also maybe how you think, it impacts advisory firms and growth in deals.
Well, the beauty of this business is that it's generally filled with professionals who understand how they impact the lives of others. And I think that when we get to that point, we realize that it's not about production or the generation of revenue or even how the investment returns are, but whether or not you're transforming the way in which people feel and think about money. So when I look at authenticity, the question is whether people have that kind of mission in their life and in their business, and how they relate to other people, and whether or not they are continuing to create this legacy in their lives beyond what they do for a living. There was a quote I read some time ago that has guided me in this whole notion around authenticity and relationships with others. And it goes something like this, that the greatest indignity one person can commit against another is to underestimate them. We do this by expecting little of them. What I find now is that the people that I meet, I don't expect little of them, I expect a lot from them. And it changes the relationship. The question is whether other people can do the same, or whether they'll denigrate the people who they encounter.
Wow. What a great way that's a perfect way to end, Mark. Thank you so much for being on the show.
Thanks so much, Corey.
And thank you, Fueling Deals listeners, for tuning in. Remember, there's only one difference between companies that grow inorganically and those that don't. And it's unrelated to size, amount of capital, or any other factor, other than that the owners and executives of companies that do deals make a decision to do deals, and then they take action. Well, it's time to refuel. So until next week, Corey Kupfer signing out.
Thank you again for tuning in. Be sure to leave Fueling Deals a rating and review on iTunes and Google. Check out all our episodes at fuelingdeals.com to find out more resources to accelerate your business growth.